Well, hi everyone out there. We are going over our ETF report, and this is Friday, for Saturday, April 13th, 2024. And I'm recording this near the close on Friday. And we're looking at the NASDAQ top 12 stocks that are rocking and rolling. And folks, with the market down as much as it is today, we are talking about hedging. It's all we're talking about, hedging and getting a good return while we're doing it. And let's take a couple of look at the charts. This is the 50-day moving average, and this is the technology ETF. And folks, you see this indicator down here, it's just pointing down, and this market pretty much is staying stable but starting to roll over here. 50-day moving average, and we are flirting with that moving average right now as we speak. Let us look at the weekly chart, because a lot of technicians like to look at weekly charts, and we see a higher high in here. Again, this is the technology ETF, the XLK we're using. We see a higher high here, but with this indicator, we see a lower high, and we have a negative crossover here. So this line with a lower high, while the market made a higher high and now turning down, is just not a good sign. So we'll have to sit through this weekend and worry about Monday coming for sure. All right, let's go to the Dow. And the Dow, this is the 50-day moving average here. First of all, this indicator up here is doing nothing except pointing down. And the Dow Jones has broken through the 50-day and now sitting on the 100-day moving average. And I'm recording this just before the market is closing. And this intermediate term indicator down here pointing down. So we have everything pointing down, folks. Even though we had a couple of good days this past week, we had some pretty nasty days also. And let us look at the QQQs, which is the NASDAQ 100. And we are looking at the 50-day moving average. Up here, we are looking at a downward sloping indicator. And folks, it just doesn't look good. So we're trying to hold this 50-day moving average in here, which we hit on Wednesday. It's right in here. We hit this on Wednesday, had a beautiful rally on Thursday right in here, and now on Friday we are trying to make a bottom in here, but we'll see. We have a lot of downward trending lines, and it will take a good couple of days. If it does reverse itself, take a couple of good days in here in order for it to firmly make that bottom in here. But you can see we are riding that 50-day moving average for the past week and a half or so. Now let us look at the returns for this year so far. And you know how our strategy works. We pick the best stocks, the above average stock in each ETF or each index. And why buy the below average stocks when you can know how to pick the better performing stocks or the above average stocks, and you outperform just about every time the particular index or ETF itself. So out of the 100 QQQ stocks, we picked 12, and right now it is up, or they are up 20.8%. The market is up 9% and falling as I'm speaking. QQQs are up almost about the same, about 8.8%. But our top stocks are up 20.8%. Now, if we hedge, and we hedge with the inverse, 3-to-1 inverse QQQs, which stock symbol is SQQQ, so you're short for the QQQs. And folks, this was developed for IRAs, because in IRAs it's hard to hedge your portfolio because the Securities and Exchange Commission will not let you go short in an IRA. So they invented the inverse ETFs so that you could buy the inverse ETF, but if the market goes down, what you bought actually goes up. So that's a nice place to be. Now, if you're 10% hedged, it only takes 3.3% of your portfolio value. So you take that cash, 3.3%, and you invest the other 96.7% in these 12 stocks. All right, so even though you're buying 3.3% of this inverse ETF, it's an inverse 3-for-1 ETF, so you are insuring 10% of your portfolio with only 3 20.3% of the equity. So when you take 96% of your money, 96.7% of your money, and invest it in a portfolio that's returning 20.8%, you don't get 20.8%, you get a little less. You get about 20% because you didn't invest 100% of your money, you invested 96.7%. And then on the hedge, because the market has been going up, the hedge lost money. The inverse QQQ lost money. If you're hedged 10%, then you lost about 2.3%. So all in all, after that all is said and done, you're still up 17.9%. Are you outperforming the S&P 500? Yes, you are. Now, what if you hedged yourself 30%? Because don't forget, tech stocks and semiconductor stocks are more volatile than the rest of the market. So if you want to hedge 30%, since it's a 3-for-1 ETF, you have to take 10% of your money and use it to buy the SQQQ. So now you have 90%. Since you're using 10% to buy your hedge, you have 90% to invest in this portfolio that has returned 20.8%. So 90% of 20.8% is about 18%. Now, you lost, since you're hedged 30%, you lost 6.8% on your hedge. So when you figure out how much you made, you have to take 90% of this 20.8% that our top stocks made, and you lost 6.8%, so you have to subtract that. So it gives you 13.3%. So if you're 30% hedged, you have, as of a few hours ago, you have 13.3%. If you didn't hedge at all, you would have 20.8%. But we like to be hedged, don't we? Did we make more than the S&P 500? Yes, we did. All right, now we're going to look at 3 different years. Let's look at 2022. And we're looking at the end of 2021 to the end of 2022, and it was a down year in the market. The QQQs were down 33%. 2022 was a nasty year. S&P was down 19.5%. What did our top stocks do? Down 41.9%. Ouch, that hurts. Now, if we were 10% hedged, and without going through all the numbers, we would have lost 32%. That still hurts. Now, what if we were 30% hedged? We would have lost 14.8%. What did the market, the S&P, lose? 19.5%. Did we lose less than the market? Yes, we did. Okay, let's go to 2023. So 2022 was a nasty year, and now we're going into 2023. And folks, after a nasty year, usually the very next year, you can double the S&P 500. You do very, very well. In fact, our 30-stock portfolio that invests in S&P 500 stocks over 3 nasty declines. We're talking about the decline, the dot-com bubble. We're talking about 2008, the housing bubble, and then we're talking about 2022 when we outperformed the market itself by double once we came back. Now, the top 12 stocks returned a whopping 99.5%. Now, what if you were 10% hedged? Well, you lost less because your hedge lost money. The market's going up, so the hedge to the downside actually loses money. You lost about 7.5%. So all in all, you made 88.7%. 30% hedged, you made 73.6%. Is it more than the S&P on the upside? Yes, it was. Now, the slide before, this one right here, when the market went down, did we lose less than the S&P 500? Yes, we did. And now in 2023, did we make more on the upside than the S&P 500? Yeah, almost 3 times as much. So very, very nice, folks. Now, let's come back to 2024, and we're only into this year about 3 months and a little bit less than 2 weeks. And what have we done so far? Our 10 stocks are up 20.8%. If you were 10% hedged, we're up 17.9%. If you're 30% hedged, you're up 13.3%. Even 30% hedged, are we making more than the S&P 500? And the answer is yes. Now let's put all these numbers together. Okay, 2022, 2023, 2024, and then we compound these numbers. So our top stocks in 2022, that nasty year, lost 41.9%. S&P lost 19%. If you were 10% hedged with these top stocks, you lost 32%. If you were 30% hedged, you lost 14.8%. But in a nasty year like 2022, did we lose less than the general market? Yes, we did. And folks, that's about 5 percentage points difference between the 19.5 and the 14.8. But that represents about a 25% difference. 5% divided by this 19, almost 20%, gives you a 25% difference. So that's pretty nice. Again, did we lose less in the down year than the market? The answer is yes. Did we make more than the market when we were 10% hedged in 2023? Yes, we did. Did we make more if we were 30% hedged? Yes, we did. We made 73.6% while the market was up 24.6%. How about in 2024, this year? Are we ahead of the S&P 500 in an up year? Yes, we are. We're up 13.3% if we're 30% hedged. And the S&P is up 9%. Now, if we're not hedged, we're up 20.8%. But let's say we had put money in at the top of the market. So usually a lot of research says, okay, we got in at the bottom and now here we made all this money at the top. But here we are getting in the top in 2022. Actually, it was the end of 2021. And for 2022, we lost money. So we're starting out losing money. So that's hard to make up, folks. But if you had not hedged, you would have lost 41.9% in 2022, made all kinds of money 23, and making all kinds of money this year in 2024. Compounded, if you put a dollar in, you would have made 40% or 40 cents on that dollar. Now, what about the S&P 500? If you compound all that, up 9%. What if you were 10% hedged? You'd be up 51%. But don't forget, you lost more than the general market in 2022. What if you were 30% hedged? Well, you'd be up 67%, because in 2022, you didn't lose nearly as much as all these other scenarios. Now, folks, this is a model portfolio that we're talking about here, but you're up 67%. If we didn't have this negative year in here, or we started at the bottom and went to the top, yeah, we'd be way ahead in the top stocks. But you're going to have that down year once every 3 or 4 years, or maybe even less than that, and you don't want to be in this position where you're not hedged at all and you're losing a lot of money. 42% is a lot to lose in a portfolio, folks. So what we're looking at is, as we test and as we go along, if you're 30% hedged, you wind up losing less than the market, but overall you gain much more than the market. So that's how you can use something that was invented for IRAs. You use them in regular portfolios, and you hedge those risky stocks, but those riskier stocks, because we're talking about Microsoft, we're talking about Google, we're talking about Amazon. So we're not talking about little bitty stocks that could disappear overnight. We're talking about the big boys out there, folks. So you want to be able to be hedged, and all this scenario is that we're hedged all the time. We're not timing the hedges here in this example. We're hedged all the time, and we're still coming out way better. We're coming out 7 times better than the S&P, and we lost less in that nasty year of 2022. So, folks, Hedging is really pretty good. You got to follow our newsletter in order to do that. And a lot of you want to have it done by professional money managers, so we can let you know who they are. And folks, you can sleep at night. You're hedged, and yet you're going to make more money than the S&P, and hopefully in the future you will lose less money than the S&P. But overall, it looks like every test we have done and in actual portfolios, we're outperforming the S&P 500 and taking less risk doing it. So, folks, we had an unbelievable week this week. We had the market going up. We had the market coming down. We had the market going back up and then coming down drastically. So this coming week is going to be some week. But look at our Saturday market review that comes along with these videos, and you'll see there might be hope that we could turn around here. We're not dead in the water yet, and we're getting close to a buying situation, and that's where you want to be, folks. So go out, enjoy your weekend, have a good time, be with your family, be with your loved ones, have a Sunday dinner, and folks, we'll see you back here next time.